I've heard from a lot of investors recently that they think buying control of a company, that premium that you pay is higher than they've just about ever seen. I think if you go back and you look over the last 10 years, it used to be about 7 times EBITDA. Now it's closer to 12 to 13 times, so almost doubling over the last 10 years.
And for that reason, many of the private equity firms do a lot of minority stake deals. The highest area of growth actually is minority stake transaction by private equity firms, growth capital. You see much more growth capital and or minority stake deals in mature companies. So you can't buy control all the time, or the premium you have to pay is not worth it in some cases.
So you would agree with that, though? Buying control of a company is pretty expensive.
It's harder to do than before, and it's not something you don't want to do. It's better to have control, and then you can make the changes you want. But very often, if you're taking a minority stake, you do negotiate to have certain rights to change management or make certain you have impact on management changes and the ability to sell when you want to sell. So a minority stake is not completely a passive position.
Let's just talk about Wall Street's views on private equity companies, the ones that are publicly traded. David Faber interviewed John Gray earlier from Blackstone and asked him why has the stock not appreciated more? What gives? If there are so many wonderful things, why doesn't Wall Street appreciate
Well,
that?
I'd say, look, there are 3 great mysteries in the world. One is what existed before the Big Bang? Nobody knows. Second, is there an afterlife, and what it's like if there is? Nobody knows. And third, why do private equity firms not trade at a higher price? To me, those are the 3 great mysteries of the world. Now, the answer to the first 2, I'm not sure I'm going to come up with those answers, but I can tell you why they probably don't trade as well as we would like them to. The private equity world has basically been a business where you say to your investors when the business first started, pay us a small management fee to cover our costs, but give us 20% of the profits. That was an enormous change in the world of money management. For 200 years, if you managed people's money, you got a fee when the money was managed, and you didn't get a piece of the profits. Private equity people came along in the 60s and 70s and said, give us 20% of the profits. So that's how our business has really been grown, and why people give us money, because they want us to be incented to make this 20% high, because their 80% will be high as well. When you're a publicly traded company, the people that follow stocks, the analysts, they want to know not when you're going to sell a company, you might get a carried interest, because it's very hard to predict that because you don't know when you're going to sell. They want to measure your management fees, how much money you're making on fees that are very predictable, so they can say to their customers or clients, in next quarter, Carlyle or Blackstone will earn X, and next year they will earn Y. And therefore, there's a big premium on management fees, which our investors don't really want us to earn too much of. There's a little premium on carried interest, which is what our investors want. So there's a bit of a dichotomy there, and we're all sorting our way through it. Clearly, a lot of people have commented, as I have, it's not really fair in some ways, because we have built these gigantic cash cows, money machines, but they aren't valued as highly as we think they should be.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.